Hello, everybody. This is Jeremy Finger with Riverbend Wealth Management here in Myrtle Beach, South Carolina. Welcome to the call. The call today will be on market volatility and what you specifically can do today and in the near future to help your financial position. There is a variety of different demographics on the call, so there's going to be many things that may pertain to you and some that may not, okay? What I encourage you to do is ask a question. Just click the Q&A, ask the question, and I'll try my best to answer every question. And I'm going to use, when I go through this, I'm going to use examples, use some slides, go pretty quickly, okay? I encourage you also to have a pen and piece of paper and write down whatever may stick in your mind. And if you got questions about that, you can ask me on this call, or you can send me an email, text, or a phone call, and we can discuss it on a one-off basis, okay? So a little bit about me. I grew up in Nichols, South Carolina, about an hour west of here. Went to College of Charleston and studied biology, chemistry, and business. I graduated from there, applied for a job in Charleston and a job in Myrtle Beach as a financial advisor, and I've been doing this for over 23 years. I'm a certified financial planner and a certified investment management analyst, and I got that at the Wharton School of Business. Okay, so thank you again for this call. The intent for this is not only giving you actionable ideas, okay. It's also able to try to share with you some perspective on what we're in today and be able to deliver this information to you quickly, timely, authentically, and in the comfort of your own home. And this is a rarity, okay? It's a rarity that I've experienced being able to do this for clients, or any financial advisor doing this for clients, okay? So let's just jump right in. First off, I do want to talk about the virus, the coronavirus out there. That's one of the main causes of the volatility that we're seeing right now. Number one thing to do is be healthy. Okay. Try social distancing, which, by the way, hopefully you're doing by being on this call, and in the comforts of your own home. But also, you try to get some exercise, walk outside, enjoy the weather. Those of you who are in South Carolina, well, we've had some pretty good weather right now. Order takeout. Most of the restaurants are closed. Order takeout. Tip your waiter and waitresses who do box that stuff up. You know, they are going to be struggling in this period of time. Communicate with your family. Read a good book. Board games. All the things we used to do 30, 40 years ago, okay? Just pretend like we're just jumping back in time for the moment. So the volatility with the market, okay? So there is a lot going on, and it's all on the news, and I do want to share with you some of the things that put this in perspective, okay? Remember to ask questions. All right, here we go. All right, so what has the greatest impact on investment results, okay? This is time and time again, the biggest harmful action or harmful catalyst on investment results is investor behavior, okay? U.S. stocks in this particular example here from 1998 to 2018 averaged 7.2%. The average investor, I'm talking about stock investor, is average 3.4. That is typically by people adding money in when the market's high and selling when the market's low. And I've seen people do this time and time again. And let me see if I can do a quick poll here. I'm going to launch a poll. How many of you know someone who has sold their stocks, whether that be currently or in the financial crisis of about 10 years ago? we'll leave that poll going on for right now, and we'll see what the results are there. All right. 100% says yes so far. Oh, I got a couple no's. All right. So right now we got 2/3 of the people said they have heard of they do know of someone who sold their stocks, and we've got 1/3 of the people said they do not know of anybody who sold their stocks. So 7.2% versus 3.4. That's a gigantic difference. And so a lot of times people are saying, well, what's the expense of this mutual fund versus that mutual fund? And that does matter. The giant difference is investor behavior, making sure that you're dealing with someone you trust, and there's a variety of different factors I'm going to go over that would help alleviate some of this investor behavior from causing you and your family harm. All right. Okay, so all right. So let's just say you're invested for 20 years. Okay. The average annual return for stocks is, I'm going to do this. Average annual return for stocks, 7.2%, as we've seen before. And if you put $100,000 invested in 1998 and just put it in stocks and got the rate of return of the index, you would have averaged 7.32% and got $410,000. Now, this is crazy, but if you only miss 10 days out of 20 years, okay, 10 days out of 20 years, your return would have gone from 7.32 down to 3.78. All right, so instead of it being 410,000, 209,000. Just 10 days being out of the market, just 10 of the best days being out of the market, your returns drop dramatically. Now, the crazy thing is that the very, very, very best days tend to happen right along some of the worst days, okay? 2008, October 2008, September of 2008, November of 2008. And so we cannot predict when these best days are going to happen. My goodness, I wish we could. I really do. But that's not possible. And so I've got clients who say, and some other people, those of you who are clients, typically I've had this conversation with you before, and you know what I'm about to say, but is that it is impossible really to say, the market's high, let's sell out now, and then we'll buy back in. First off, you got to be exactly right twice. Sell it right, and then buy it back in right. I have, in 23 years, in reading dozens and dozens and dozens of books and thousands of hours of conference calls, I have never heard of anybody successfully and consistently being able to do that. Now, I know plenty of people on the golf course, and they know what I'm doing, right? Yeah, I sold out. This was back in the financial crisis. I sold out at 12,000 with the idea of getting back in at 10,000. Well, as you know, the market ran up to 29,000, and since it's retreated back to 20,000. But so it is very, very difficult. It's really impossible to be able to time the market. So what's really important is to stay invested. Okay, stay invested if you've got good investments, and we'll get into that in a moment. Okay. These things here. All right, so bad news. Man, I tell you what, how much news is out there right now is, gosh, all the time. So there is always bad news out there. And bad news is really at the peak of market volatility. Okay, so good friend of mine, we talked about this the other day. He says, well, if we know there's bad news coming or worse news is yet to come, doesn't that mean the market's going to go down? Not necessarily. Okay, and let me tell you why. the markets are a leading indicator, meaning that before the bad news comes, typically the market is already anticipating that and reacting to it. Okay, just as you have already experienced here now, the market really has gone down dramatically in a very short period of time, anticipating earnings being poor for the second quarter and the third quarter and possibly the fourth quarter. They're already anticipating that. Real example here is, and guys, don't hold me to it exactly, okay? But this is general. The peak of unemployment back in the financial crisis was in November of 2009 at 10.2%. The market hit dead bottom March 9th of 2009, so about 6 to 8 months before, okay? If you waited, you probably would have missed a 30% increase in the market value of the stocks. It's a leading indicator. You can't wait. Well, let's just wait till the market settles down. Let's wait till we hear some good news. By the time that happens, the darn thing's up, okay? It's just up. See, questions, comments, questions? No open questions. All right. All right. So volatility does not equal financial loss unless you sell, okay? Now, some of you guys may have some investments that you should sell, and I'll talk a little bit about that, or reallocate, let's say it that way. But when markets go down, it doesn't mean this that you've lost. Okay, so this is each year, 84, 86, 87, and the years in between. This is what the total return of, let me draw on this thing again. So the total return of each year and what the market was doing at that time, or what's the absolute low of that year. For instance, in 1984, the peak bottom was 13% loss. In 1985, the peak bottom was negative 8%. But the market ended up 6% here, up 32%, and so on. The peak bottom of 2008 was 49% loss, but it ended up only being down. Can you believe that I'm saying that? 37%. Okay. So what you're seeing here is the average down during the year is minus 9.9%. But the average annualized total return in this example here from 84 to 2008 is 13. Okay. So just because it's down in the middle of the year doesn't mean that it's going to end that way. All right, just volatility is part of it. Okay, again, this is all stocks. Most of you do not have all stocks. Moving on. All right. So how long does it last? How long does it last? Downturns last. Well, we've ever seen this before. Well, drawdowns of 5 to 10% they happen 40 times. They've happened 40 times since 1945. And the recovery time is 3 months. 10 to 20%, 7 months. 20 to 30%, 25. So recoveries can, and they vary on how long it takes to recoup. Okay. I do want to show you one more graph. Let me see which one I want to show you here. If I had a great singing voice, I'd go ahead and sing for you, but everybody would certainly drop off. All right. There's so much information out there, and it's just, and I see so much of it. So that to disseminate all of that information and give it all to you would be it'd be very difficult to do. But I just want to give you some bullet points. Again, this is annualized returns or the green, and the downturns are the red. As you can see, there's a heck of a lot more up than down from 1926 to 2019. Let's see. Okay, here you go. This is, I'll show you this. All right, perfect. Okay, negative news. Okay, news. S&P 500, when the S&P 500 was dropping in 2009, viewership of CNBC spiked, okay? And then as the S&P 500 rebounded, viewership of CNBC dropped. So people just like bad news. I mean, it sells, unfortunately. I guess we're sick. We are part of the problem of this drama, okay? We tend to overshoot on the upside and overshoot on the downside. So, yes, we're part of the problem. All right, so a few things that you can do, okay, right now. Those of you who are not retired yet, continue to save, okay? Make sure you're having good investments. I will review anything you have with no obligation whatsoever, and you can either do it yourself or stay with the advisor you're in. You can just no questions asked. Okay. If you are not retired and you're able to save. Okay. The second best thing you can do is don't sell. Dividends are constantly being paid depending on what types of investments you have. And when you dividend reinvestment, if you don't sell, you're buying more shares when the price is low. And right now the price is low. And so when things do rebound, your account values go up a heck of a lot more than they went down. And the absolute worst thing you can do is sell out completely. But what you can do is to rebalance, okay? So right now, is that a number of things that people can do in their taxable accounts is they can take, I'm not a tax guy, I'm not a CPA, this is just tax planning advice. You could sell one investment and reallocate it to a different investment, okay? Take the tax loss, and then when things rebound, you're gonna participate on the upside with the new investment. Well, why would you do that? There's for a few different reasons why. Number one, you're taking the tax loss, and you're be able to hold on to that tax loss to offset any gains you're going to have in the future. Number two is that when you rebalance into a different investment, if you've got a good advisor, obviously ask me, is that you may be upgrading your portfolio. I mean, you may be upgrading the quality of the investments that you have right now, okay? So tax loss harvesting. Another thing you can do, those of you who have IRA accounts, okay, and let's say, for instance, this is going to be a challenging year for you income-wise, right? So your tax bracket may be low. Since your IRA is dropped in value, you may be able to convert that IRA to a Roth IRA, okay? All right, so and then you got to pay taxes on whatever you convert, okay? Let's just say your $100,000 your traditional IRA dropped to 50. You take 50,000, move it over to a Roth, you got to pay taxes on that 50,000 now. And then now your money's in a Roth IRA, and that grows based on current rules, tax-free, and you can withdraw it tax-free as well. Okay, so now is a great opportunity to be able to take care of Roth conversion. Those of you who are nervous about the market and they're approaching retirement or absolutely can't sleep at night or whatever, annuities could be an option. Because I'm a fee-only financial advisor, we can get some dirt cheap annuities with some guaranteed income streams there. with flexibility of getting in and out of them if need be. Ask me questions, okay? Ask me questions if you want to know about that. Also, fund your HSA account, your health savings account. You get a tax deduction on the front end, grows tax-free, comes out tax-free for any, health-related expense. These accounts, IRAs, 401ks, anything you got to contribute to for the year 2020, try to do it now if you've got the cash flow to do it. Okay? All right. Well, hey, Jeremy, I'm retired and I'm living off my money, and so how is that going to happen? How's that going to work? Oh, or Jeremy, hey, I'm retiring in a few years. I'm concerned about this. Am I going to be able to retire? Guys and gals, if I did a plan for you, okay, it includes periodic times of bear markets, okay? It includes periodic times of bear markets. It is not like, that these plans are designed for only an 8% return every single year. It is preparing for times like this, up and down, up and down, up and down, up and down. Now, what are some of the things you can do, okay, in this particular time? Many clients, I encourage them to have emergency funds set aside, okay? Those of you or those that are taking income, now's a great time to use some of the cash set aside for their living expenses now versus liquidating some of their investments at the low price. All right, wait this thing out. Okay. For those of you, for any of you really, there are some investments that have actually done very, very well in this environment. Okay, U.S. Treasuries being one of them. And they've gone ridiculously, in my opinion, high. And it's just best to sell it and put cash on the sidelines. Many of you have done that, okay? Many of you who are clients, you may not know this, but I was being a little strategic and a little defensive with your money at the beginning of the year. So the downside, even though you experienced it, is much, much less than it could have been. So there are pockets of investments that if you don't have cash already in the bank to be able to weather this downturn, weathering the downturn meaning living off your income, there are maybe some portions of your money that can be sold to generate cash for you to live off of, for 3 months, 6 months to a year, to wait this thing out and going that way. Now, again, having a plan. Every one of you who has a plan with me, I have designed the plan accordingly to withstand some of these downturns. That does not mean your investments don't go down. What it does mean is that if I told you an income that you could receive from it, it's about the same, okay? Now, what I would encourage you to do right now is if you got a major expense coming up, and you can defer that expense later, wait to buy the car. Instead of going to Europe for a vacation, maybe go to Florida. Try to defer and reduce your expenses today, okay? Because we don't know exactly how long this recovery might take. It might be 2 months, it might be 3 months, it might be 6 months, it might be a year. Nobody knows for certain. Okay, but if you have cushion, that is going to help you reduce investor behavior, investor shock. What was that? Another slide. If you have a cushion on your a cushion of cash, it's easier to not be so emotional. Okay. Those of you who have kids or grandkids and are contributing for their education, whether it be private schools and they're staying in private school, put money in 529 plan. And then you can, this down now, add it there as well. Let's see. Okay. So those are numerous different options: Roth conversions, tax loss harvesting, upgrading the quality of your portfolio, annuities when appropriate. Use this time to add 529 plans, a health savings account. But a question for you guys is that, do you think this coronavirus is a permanent thing? Okay. The answer is no. Do you think we'll recover? Yeah. Now, the uncertainty is when, okay? We don't know when. So think of it like this. Imagine you're looking at a valley, and you got to cross the valley, right? Yeah, that may be a bit of walking to do it, but you actually know that you can get to the other side. Now, whether that be the end of this year or the end of next year, we will recover, okay? We will recover. Now, will businesses be the same? Okay, some businesses, especially in Myrtle Beach, it may hurt some golf courses and restaurants and hotels. Absolutely. That's real. Even though the virus may not be, prevalent, it may hurt some of these people. Absolutely the case. But going forward, are we going to recover? My goodness, guys, absolutely we will recover. Will the landscape be a little bit different? Well, maybe this type of call is the new normal. Okay, maybe this type of call is the new normal, and instead of doing face-to-face meetings all the time, we do webinars like this. Okay, or maybe we start staying at home more. I don't know. Now I'll say this is that medical technology will probably increase, testing will increase, emergency precautions for outbreaks like this will increase. There is many different times in history. Some of the best businesses were born in the area of crisis. Okay, Microsoft and Apple started in the late 70s, for example. So there are going to be some good changes and developments because of this. But again, that's part of the valley, guys, is that making smart decisions, do what you can today, try to be a little bit more frugal with your dollar, have cash on the sideline when appropriate, take advantage of tax loss harvesting if you can. Call me, text me, email me, no matter what, no obligation whatsoever, okay? I'll be willing to help you in any way possible, okay? So questions, any questions? Questions? If someone can, now again, I love you, but I'm kind of new to this technology. If you could ask a question, do so. If you can't, if there's something up with the technology, I'll fix it and make it sure it's right next time, okay? I am planning on doing conference calls like this on a regular basis, okay? So if you've got a topic or concern or something you're interested in, let me know, and I will make sure I bring it up on the next call, okay? Let's see what here. My telephone number is 843-222-6602, 843-222-6602. Email address is jeremy@riverbendwm.com, jeremy@riverbendwm.com. And call me, email me anytime. Update your plan, update your will. Oh, that's it. So thank you very much for your time. If you, again, got any questions about anything, be sure to give me a call. Oh, whoa, here's a question. By the way, all these questions are anonymous, okay? In the last major downturns, how much has the average dividends reduced by companies conserving cash? Oh, that's a great question. So in other words, for example, okay, great example. This happened today, and at least I think I heard it today. Is Ford Motor Company was paying a dividend, and today, because of the slowdown in the economy, they cut their dividend. So it's like how much in these last major downturns has the dividends been cut? I don't know, but I can find that out. I can find that out. Some companies could cut their dividends in financial downturns. Now, part of upgrading your portfolio is doing what? Purchasing good, solid balance sheet companies that typically have sustainable dividends even during downturns. Okay, if a company is over leveraged and has all this debt, they may not be able to sustain the dividend. Okay, great question. One other thing to mention, okay, is my goodness, is this inflation. All right, so inflation is 2.1 in this particular example. The cash is paying virtually nothing right now. Okay, the 10-year Treasury bond, that fluctuates a little bit, but let's just say it's right around 1%. The current dividend rate on the S&P 500 is, guess what? If you're getting 1% on the U.S. Treasury, I mean, what do you think you're getting on the stock market, or just the S&P 500? It's yielding 2.5% right now, over 2.5 actually. So you're making 2.5 times the income on your stocks than you do on cash. Okay. Now, fast forward across, visualize being across this valley. The valley I'm referring to of the recovery. Let's say it's 2 years down the road. Let's say it's 5 years down the road. 5 years down the road, would you be better off selling out and going to cash at 1%, or maybe holding some good quality companies that are paying 2, 3, 4% or more, and holding them for 5 years? Visualize ahead. Now, Jeremy, wait, I'm retired. I need my money now. Let's say you're retired right now. Nobody needs all their money right now. Typically, the withdrawal rate from their investments is right around 4%. So they have 96% of their money still invested. Okay, and that is the dividends are reinvested, buying more shares when the price is low, so when the recovery does happen, the portfolio does fantastic. Okay, now I've got clients who've been retired with me for well over 20 years. I've only been 23 years, but so they've been through the dot-com bust, they've been through 9/11, the financial crisis, and they still play golf. They still went out to dinner, and they still live their life. They still play with their grandkids and everything else. Now, sometimes when things are good, they go to New York Prime. If things are like this, maybe they go out to dinner. A bad example now because the restaurants are closed, but maybe they go to Applebee's or they go to the Snack Shack. Okay, so people tend to, when things are well, they spend more. When things are not as good, they spend less. This is one of the times when if you can, spend less. Okay. Any more questions? God, that was a great question. I have to tell you, I'm really excited about the technology here to be able to communicate to you and everyone in a very timely, efficient fashion, and truthfully be within the comfort of your own home. All right. Anything else? Okay. Wonderful. Well, thank you very, very much for attending, and let me know if there's a topic you want to hear about. Email me, text me, call me. I'd be happy to review anything you want me to, answer any question, okay? No obligation to do business with me. Let's just suppose, for instance, you did want to do business with me. All your money will be held at Fidelity Investments, an $8 trillion company that took no TARP money. I mean, no, they typically pay 4 times the amount of interest on money market rates as well. We could do all this virtual. I can do DocuSign, where you don't even leave your house, and set everything up. So just a thought. If for those of you who are clients that want to review your investments and your financial plan, that's fantastic. Email me and we'll set up a time to do just that. Okay? All right. God bless you, and have a good night. Oh, if you can hear me, yes. If you can afford to do so, stop your dividends and reinvest them now.